Hi guys, welcome to Investing with JYK, and today we'll LGIH. So I went through all their monthly reports back to 2014 and then put their monthly closing numbers here and then all the way to 2018 and did three graphs. The monthly closing graph, you can see it has a lot of ups and downs, and so this is hard to see. So I basically did a trailing 12 month on this graph, and you can see the trailing 12 month looks pretty good. Other than like it was a steady increase, other than early 2017. And this is the stock price graph. So when I got in, it was end of 2016 and early 2017, and I think I bought in here and here as well. I mean, looking back, I guess I could have bought a little bit more here, but I didn't know enough. So when I did the site visit, it was somewhere here, I think. I actually went to visit the places. So you can see that even though the monthly closing thing is up and down quite a bit, the yearly closing is the trailing 12-month closing is fairly steady, and also recently we might even be looking at a slight uptick. If you look at this graph, right? If you just project it out, you get it somewhere here. So it's some a little bit higher than what you would expect. You know, if from a plain projection point of view. And then the cheapest is when the growth was in question. So that's very interesting. Um, when the inflection point happened here, you can see the inflection point happened in the stock price as well. Very interesting things. I'm not sure what to make out of it, but it's just an observation. And the other thing that I wanted to check was Fed fund rate. So I checked Fed fund rate, trying to find if there's any correlation. 2017, early 2017, that was definitely when the rate jumped higher, but the rate jumped in November already. So by the time in December, uh, it was already like peaked out. So it kind of got slightly lower, in spring of that, well, in the early part of the year of 2017. Now, looking at the monthly closing, the trailing, you can see it actually did peak out at December-ish, and then it started going down. Well, this is actually December, and then started going down, and so there we can see some kind of correlation, but I'm not sure if that is the exact reason, because I remember early in 2017, LGIH was talking about inventory issues, that they don't have enough houses to sell. So I'm not sure which one explains it better. And then during the acceleration, the peak acceleration at late last year and summer of last year, let's see. So those were when the 30-year fixed interest rate was somewhere around 4% instead of 4.3. Right? And then if you look at currently, it's at something like 4.6, so much higher now. But we do see that even though there's a drop, but this is very likely just seasonal. If you look at the graph, every single January there's a drop. Obviously, the drop in 2017 is especially bad in 2007, 8, um, but they seem to recover fairly soon. So this whole market seemed very seasonal, which is completely insane if you ask me, because you're buying a house. Who the fuck cares when you buy it? But people seem to have um, a tendency to buy houses in the summer. I mean, I know that is the case. I've heard many people talking about it. I've seen um, numbers. It's just something I don't get. I don't understand why. Maybe you guys can teach me. But yeah, so the raising rates definitely is, in 2017 it was coinciding, the raising rate was coinciding with the seasonal low, and then plus low inventory. I don't know which one plays more importance in this, but 2018 we won't know how this thing will develop. But let's say that uh, we can get back to, we're already over 2017 level, obviously, because we were, if you look at the numbers, uh, yeah, this computer is struggling. Welcome to the world of dramas. Oh, let's look at 2008 April. The closing was 606 houses, and trailing 12 month was 6,500. And if you look back in 2007, it's quite a bit more. If you go back in 2006, it was more, but not that many more. If you go back a little bit more, I'm not sure if this thing. 2015, it was again. 2016 was more, but actually quite a bit more. So there is this consistent growth here, and again, the logic for LGIH was, it was building the cheap houses, and there are not enough cheap houses in the market. And they build the cheap houses in the most efficient way possible, no options, fast turnaround, and I think they should continue to do well in this market because of the demographic tailwind, their business model, their selling practice, um, and the target customers. But the biggest risk is still there. It's just mortgage rate, and some of that has already manifested itself. Mortgage rate is already 4.6 compared to 4.3 in early 2017. Let's see how this goes. I'm still holding. I think reasonably this thing can be $100 plus if they keep growing at this rate. Even if the growth rate slows down, 20% per year, 25% per year, it's still very attractive investment at this price. Okay, this is it for the update, and I will see you next time.